Welcome, everyone. My name is Joe Bloodgood. With me today is my partner, Nathan Faith. We're happy to be back with you today. And today's topic is going to be around health savings accounts, or HSA accounts as they are commonly known. So first, just around contribution limits. These limits tend to change a little bit year to year. For 2020, an individual can contribute $3,550. A family, in other words, a couple, two or more, can contribute up to $7,100, plus $1,000 if you're over the age of 55. Pretty basic in terms of requirements. You just can't be eligible for Medicare, and you need to be enrolled in a high deductible health insurance plan. Uh, After that, as you'll learn throughout our presentation, you have really ultimate flexibility with these accounts and a lot of tax advantages. So let's take a look at some of those details. All right, before I turn it over to Nathan, the first thing I'll show you here is just that these accounts are quadruple tax advantaged. In other words, they're tax deductible, they're FICA tax free, they provide tax-free growth along the way, and tax-free withdrawals, assuming they're used for medical. Nathan, take us through some of the details on that.
Yeah, thanks, Joe. We can't stress enough how wonderful health savings accounts are. They've only been around for a little over a decade, but they really have the best of all worlds when it comes to tax advantages. So here's an illustration of why HSAs are really the best place to put your money and protect it from Uncle Sam. So when we look at the most common type of retirement accounts, IRAs and 401ks, you get a really good deal going in. You save taxes, that's that green arrow, but you got to pay the piper when you withdraw money. That's the red arrow. A close relative of IRAs and 401ks are Roth accounts. They're just the opposite. See the red arrow going in? That means we pay taxes on the dollars going in. However, our wealth can grow and be distributed from those accounts completely tax-free. Now look on the far right at the health savings accounts. Like IRAs, you receive the tax deduction going in, not just on your income taxes, but on your Social Security and Medicare taxes that you pay with every paycheck. For middle class folks, that's a 40% tax deduction, which on a HSA contribution of about $7,000 saves you close to $3,000 per year in taxes. Now, these accounts then transform into a Roth IRA in which, if invested, and that's another key point, we recommend for everyone who can afford to invest their dollars in their HSA and not distribute them until they need them later in retirement. It's better to withdraw cash you need from your checking account and allow your HSA to grow over time, which will illustrate why. And then finally, that green arrow pointing out of health savings accounts, you can distribute dollars for qualified medical expenses tax-free at any age, at any time, no questions asked. And that quadruple tax benefit, tax savings going in on income and payroll taxes, tax-free growth, and then tax-free distributions, is why health savings accounts are the best place to save our money. So Joe, do you want to speak to the costs of healthcare in retirement?
Yeah, absolutely. Thanks, Nate. So on the screen right now, you can get a sense of how those costs are broken down and a better sense of what the average total amount might be. So on the left-hand side, you see a yearly total of about $13,600 in terms of yearly medical costs in retirement. And if you extrapolate that out over the course of a 25-year retirement, you can see a grand total of about $340,000 over that period of time. And you can see, if you're interested there, how those dollars are broken down between Medicare Parts B and D, Medigap insurance, long-term care, and dental and vision. But as we move to the next slide, this will illustrate the power of these HSA accounts. And so if we look at how these accounts are funded, and if we assume that someone maxes out their HSA for the 25 years leading up to retirement, so from today to say retirement in the year 2045, and a modest rate of return in those dollars of say about 5%, you can see how that account value grows over time to the point where at retirement you've accumulated nearly $500,000, which allows you to comfortably wind that money down in retirement and cover the cost of those medical costs along the way, having pre-funded them on your sort of ramp up to retirement.
So as far as key takeaways, our recommendations that we make to our clients is they should max out their health savings accounts before any other account that they fund each year. That's over 401ks, that's over Roth IRAs. We also recommend that our clients invest the dollars in their HSAs. Don't leave them in cash, put them to work, because we don't want our clients to withdraw the funds from their HSA year by year. We want those dollars to be invested to grow and to instead use cash within one's checking or savings accounts to pay for health insurance costs until they absolutely need them, say with a big healthcare event, or later in retirement when they're no longer earning an income. And by doing so, health savings accounts can grow to very, very large balances and pre-fund essentially any and all healthcare expense that may come along the way. So with that, if you have questions about HSAs or any other financial planning topic, feel free to reach out to us at learnmore@boulaygroup.com. Thank you.